So welcome everyone to the webinar, and I'd like to introduce our presenters, particularly Sandra and Sean, who will be doing a majority of the presentation and who I'll hand over to shortly. So Sandra has a significant amount of experience globally and has worked throughout the world for companies introducing and implementing executive and employee plans. And I've worked with her personally, and she's fantastic at what she does. Sean works with Allens and has a significant amount of experience, including working within companies and assisting them with their executive and employee share plans. So I will hand over to both of them, and as I said, just type any questions that you have in the chat box and we'll answer them as they go through. But both Sandra and Sean will talk a little bit about what they've seen practically, and I'll just close off with some of the final comments from me in relation to the political side. Excellent. So Sandra, would you like to kick off?
Well, actually, I'd like to hand it over to Sean. Thank you, Sean.
Thanks, guys. So the purpose of today is really to walk you through the fairly new tax changes as they apply to grants of employee share scheme interests in Australia. The changes applied from 1 July 2015, so we've now had a bit more than 6 months to get our heads around them and to see what's happening in the market and how the changes have been received. The changes, employee share schemes are quite, the taxation is quite complicated, so we will try to go through it through the tax changes quite simply in case you don't happen to look at the tax provisions every day. And we'll also let you know what we're seeing in the market in relation to the different options open to us. So we've picked a case study format for today, and this involves Sample Co, which is an ASX-listed company. Towards the end, Sandra's going to also mention the startup tax concessions for unlisted startup companies. But we start here with Sample Co, an ASX-listed company. It currently operates 3 plans, which we think are quite typical in the market. So a performance rights plan, a restricted share plan, and an all-employee share plan. And Sample Co has sought advice on whether it should make any changes to the design of its share plans or introduce new plans as a result of the tax and regulatory changes. So first up, we have the performance rights plan. So these plans, so senior employees are granted conditional non-transferable rights to acquire up to a specified number of shares 3 years after grant. The number of shares they will receive is based on performance conditions measured over the 3-year vesting period, and if the employee leaves before the vesting date, the rights will typically lapse unless they fall within one of the good leaver criteria. So these plans have been very popular before the recent tax changes, and one of the main reasons for that is that for tax-deferred plans, we couldn't defer the taxing point past vesting unless there were genuine disposal restrictions on the shares. So it didn't make sense before 1 July 2015 to have an exercise period on something that was taxed on vesting, because most people would probably choose to exercise anyway, because they'd need to sell some shares to pay the tax. So that's why performance rights that had an automatic delivery of shares after the 3-year vesting period became really the standard LTIP tool for listed Australian companies. And now let's just consider the taxing time for performance rights under the old law, i.e. this is for, when I say old law, I mean rights that were granted before 1 July 2015. 15, but not so old as to touch the old Div 13A, so not pre 1 July 2009 rights. So we're looking at pre 1 July 2015 rights versus post 1 July 2015. That's the new law. So under the old law, the first point to note is that you were only into tax deferral if there was a real risk of forfeiture on grant of performance rights. And that typically wouldn't be too contentious if there are genuine performance conditions. So you would typically be in, you would pass through the tax deferral gateway, and then your taxing point would be on the left-hand side here, the earlier of cessation of employment. If no genuine disposal restrictions, you'd be taxed on vesting, so i.e. on allocation of the shares. If there were genuine disposal restrictions, you'd be taxed on the first day when those restrictions lifted, or 7 years from grant of the award. That was the backstop. So under the new law, it's the earlier of, and we still have cessation of employment here, which is perhaps one of the biggest hangovers that we still have in our tax legislation that all of us tax practitioners and share scheme practitioners dislike. It's one of the things we probably dislike the most. So you'll still be taxed on cessation of employment, the earlier of, but if no genuine disposal restrictions, you'll now be taxed on exercise, not on vesting. If there are genuine disposal restrictions, then you'll be taxed on lifting of those restrictions, or 15 years from grant of the award. I still haven't figured out why they made this 15 years. It doesn't seem to make any particular sense, particularly because cessation of employment is still a taxing time, so not many employees stay at their employer for 15 years. So that's a bit of an introduction on how performance rights were taxed under the old law versus under the new law. So the question is, what should we look? Let's now look at our standard performance rights plan and consider the question: should we make changes to it, and if so, what changes should we make to it? So the obvious change that you could consider making is adding an exercise period post-vesting. And the reason why you might do that is because there might be some perceived value in that to employees in being able to pick and choose when they want to be taxed on their vested performance rights. So, for example, if you wanted to take a punt that the temporary budget repair levy is going to be repealed one day, you might choose to not exercise and hope that our tax rates, the top rate will come down, and then exercise in the income year when the tax rates come down. So that there might be some perceived value there for employees. And that needs to be weighed, I guess, against the cons of adding an exercise period for the company, which are that the people on this call are going to be responsible for managing the exercise process, and obviously the longer the exercise period after vesting, the more administratively on the ball you're going to need to be to make sure you are aware of all the outstanding unexercised rights that your company has on foot. You're going to have different ESS reporting dates for each time someone chooses to exercise. That's going to be a taxing point, so you're going to need to keep track of that for your ESS reporting. And you're going to need to consider whether to pay dividend equivalence post-vesting. That's probably the biggest potential cost in this. The thinking here, this would be a real benefit for the employees if the company was so generous as to offer it, because really what you'd be doing is saying, look, you don't have to exercise your rights because we're going to put you in the same position economically as if you had anyway, because when you do exercise, we're going to either pay you a cash amount or we will calculate an amount of additional shares based on the dividends you would have received from when your rights vested, and will deliver an amount of additional shares to you. That would make this a real benefit to employees, to not only have tax deferral but to also have dividend equivalents calculated in respect of their vested but unexercised rights. A few other issues to think of in this context is obviously, do your plan rules currently allow you to add an exercise period? If you're still using old plan rules pre-2009, then they might already have that flexibility in there, but if not, then you're going to have to amend your plan rules. If you are going to amend your plan rules, you might want to consider having an automatic exercise at the end of the exercise period. So if someone forgets to exercise, it makes sense to have a provision in your rules that says if the option is not exercised by the last exercise date, it shall be deemed to have been exercised by that date. You would obviously only do this for free shares. You wouldn't want to do this for shares with an exercise price, because there may be a reason why those options haven't been exercised. But I've been in a call with an HR manager who was dealing with a situation where an executive just forgot to exercise a 10-year option in respect of more than $1 million worth of shares, and it was an awkward discussion for everyone, and there was no easy answer to how to deal with that. So to avoid that, you could look at drafting something in your plan rules to help you out. You should also consider how you're going to manage the exercise process in terms of potentially using an employee share trust or what we might call the bucket trust. Now, if you already have sophisticated share plans and you already have a trust set up and you are already familiar with how it works, this might not be an additional consideration for you. But if you don't have a share trust, then you'll need to consider putting one in place and the additional costs associated with that. And you'll need to consider, how to fund it, issues around getting deductions for the funding of it, and the timing of the funding, the timing of the acquisition of the shares in the trust. When you allocate shares, we would recommend that if you are using a share trust, you use it literally as a delivery mechanism for the shares. We've seen some quite complicated tax outcomes if you use a share trust to hold allocated shares, where the individual already has a beneficial interest in the shares. If you want to look at an example of that, you can Google the NAB retail entitlement offer, which happened last year, and there were some pretty funky outcomes there with employees who had shares in an employee share trust there. Not disastrous, but just very, very complicated. So these are considerations that you should keep in mind when you're entering into using trusts for employee share schemes. So we've covered managing, we've covered dividend equivalents, we've covered trusts. So now let's quickly discuss adding a cash discretion for good leavers. This is perhaps, from my point of view, if there's one point that you take away from this, it's probably this point. We had some regulatory changes in November 2014, which now mean that you can, your typical employee share rights can qualify for the new ASIC relief, even if there is a cash discretion in your rules, whereas previously you couldn't. So with that regulatory change, it now means that you can, if you're a listed company, it's different for unlisted, if you're a listed company, you can include a cash discretion in your plan rules. And the reason why you are going to want to have this in your plan rules is to manage the fact that we still have cessation of employment as a taxing time. Now, for those of you who don't know why this is such a bad thing, the reason is because let's say someone ceases, so let's say our performance rights 3-year vesting period, let's say someone ceases in year 2 as a good leaver on a particular date, and let's say they keep their at that stage unvested performance rights, bang, that's the taxing point on their performance rights, on all of them, on the date they cease employment, on the market value of the shares on that date. And that's not an optimal outcome, particularly if nothing's vested yet. Now, what ultimately happens is, if on vesting, let's say only 70% of the award vests, the employee can then go back and amend their tax return and basically only include the shares that they ultimately were delivered. But you're still faced with the problem that they'll be taxed on the market value of the share on the date they ceased employment. Now, you can imagine this would not be a good outcome if your share price has halved, because you're delivering shares to an employee on which they've been assessed to income tax on a value that's double the value of the shares that they're actually receiving. So it's just a bad, inconvenient situation to be in. Now, to come back to the cash discretion, if you have a cash discretion in your plan rules, which basically means that the company can choose at its election to either deliver shares or deliver cash to you, if you have that in there, then we've got a rule in Division 83A called the Indeterminate Rights Rule, and it allows you to effectively take a wait-and-see approach. Now, if you have good levers, you might take that you always cash settle good levers, just to avoid any retrospective reporting and to avoid the uncertainty. And the advantage is, if you do choose to cash settle, then it's quite straightforward, really, because the taxing point is simply when you pay them the cash, and that will just be taxed as salary and wages, with PAYG withholding from the payment of the cash. So you don't have any retrospective ESS reporting, and you don't have any mismatch between the value that's provided to the employee on vesting and the taxable value which they might have suffered. So adding a cash discretion for good levers is a good idea. You can't do it for unlisted companies. It's more complicated because adding a cash discretion technically makes the award a derivative, a financial derivative. And if you're an unlisted company and you wanted to rely on various exceptions, such as the senior manager or the 20 grants in 12 months rule, that's not going to help you out if your instrument is a derivative, if it's got a cash discretion. But if you're an unlisted, you can perhaps grant options and now rely on the expanded refund rule to help you out. So that's still a better position to be in than we were pre-1 July 2015. So consider adding options with an exercise price to the LTI mix. So we've discussed extending the exercise period for performance rights. So this is a completely different financial instrument. So we're talking about an option with an exercise price. We've seen in the market some companies now giving their senior executives a choice to pick, like say 50% performance rights with an exercise period and 50% options with a market value price. What we would say, from where I see it, we wouldn't advocate that there's necessarily any tax advantage in granting options with an exercise price. The way we would see it is there now isn't a tax disadvantage in granting them. So whereas there used to be all sorts of problems with it, there now aren't the tax problems. So you now can look at doing it if it fits within your REM framework. So moving along to restricted share plan. So there are really two scenarios here that I have in mind. The first is your typical deferred STI. So basically a portion of someone's bonus is deferred for 2 years into shares, and from what we've seen in the market, it's more common than not that these are actually deferred shares as opposed to rights. So in other words, if you're an employee, you'll be paid 50% of your bonus, and then the remaining 50% gets converted into shares, and then you can't sell those shares for 2 years, and if you cease employment before the end of that 2-year period, you forfeit those shares. So in that case, you know, there would be real risk in that scenario because of the forfeiture. So you would qualify for tax deferral anyway, and the taxing point would be when the disposal restriction lifts at the end of the 2 years. So what you might like to consider doing now under the new rules is potentially adding, or converting that into a right and adding an exercise period after the 2-year vesting date, so that the employee can then choose their exercise period. And everything I just said before around the considerations for adding an exercise period would equally apply here, except I think where we would see it is that it might not necessarily make sense in the context of deferred STI to go through the effort of converting it into a right for tax deferral, because it seems to more naturally fit like a share plan. And also, if you're not providing dividend equivalents, query whether an employee would actually, whether an employee would actually be better off getting a beneficial in shares for 2 years and collecting the dividends along the way. The other example of a restricted share plan that I'd like to raise is where restricted shares are provided as fixed remuneration. Let's say someone is a new joiner, and it's not uncommon that a company would want to give them shares on joining. That might be to compensate them for shares that they just gave up. Now, there's before 1 July 2015, there was a tension between wanting them to have shares and on day one, and them being taxed on the shares on day one, because if there's no real risk, then they're taxed on day one, even if there is a genuine disposal restriction. So you couldn't do that in practice. But now, you can, under the rules, provide fixed remuneration by granting it as a right on day one, and that right could be immediately vested. So there's no real risk of forfeiture, and as long as the plan documents have the right statement and you can't dispose of the right, then you can be into the tax deferral gateway. So you can provide fixed remuneration that's immediately vested as rights to shares and get into tax deferral now under the new rules. And then, in this example, you could have an exercise period of whatever, and they would be taxed, when they exercise the right. So that's something that you fundamentally couldn't have done before 1 July 2015. And the only point, this slide basically shows you the changes in the old versus the new law for restricted shares that I've been talking about. And what it shows is that for a grant of shares, there's really no change. And for a grant of rights, pretty much as we've already discussed it. And we've already discussed most of these points already around, changes to be made to restricted share plans. I guess the only additional point I'd make before I hand over to Sandra is that if you have been doing something as a share plan and you're thinking of changing it into a rights plan, we haven't seen anything yet from the ATO on how the ATO's view on how these rules are going to be administered. In the example I just gave as one example. So if something would more naturally be a share plan, and you're changing it into a rights plan, we would probably suggest going for a class ruling on something like that, or waiting for someone else to do it and getting the benefit of the ATO's views on this. But as far as the legislation is concerned, this can be done, and hopefully the ATO will take practical approaches to operating these rules. And on that point, I'll hand over to Sandra to take you through all employee share plans.
And actually, I was just taking a quick moment to see if anybody had left a message in respect of the chat. So don't forget, if you want to raise a question while we're talking, please do so, and then we'll have a look and insert the question and an answer at that point. So, okay, handing over to the controls. Here we go. All right, I'm basically just going to talk generally about broad-based plans. And when I say broad-based plan, we're talking about generally not just executive or key employee share plans. So what sort of rules were adopted as from the 1st of July 2015 in respect to broad-based plans, and how will it affect the design of plans going forward for employee shares? As part of the consultation, and I'm sure a number of you have actually been following it, the call for changes, etc. There was a call for new employee share schemes for startups, and that was adopted. And I'm going to just talk broadly in respect of what the new startup tax rules are. So if you are a startup company and you wish to offer options and shares to employees, executive and the broad-based employee group, the tax legislation was changed as from 1st of July 2015 in respect of a startup special regime, tax regime for startup share plans. There was also in the consultation calls for an increase in the $1,000 tax exemption. So you'll recall, a very typical broad-based share plan is discounted up to $1,000 per employee per year, where that share is basically restricted for 3 years, basically to get employees to participate in the ongoing operation of the company and align them. You being the employee was basically exempt from income tax on that $1,000 and also capital gains tax, because your CGT cost base up to the $1,000 discount was not taxed and formed the cost base of your CGT. There was a call for increase because that $1,000 tax exemption has been in since 1997, and I had a quick check to see what average weekly earnings was in 97, and it was about $700. And if we look now, being 2015-16, it's roughly $1,400. So basically, the $1,000 has stayed the same, even though you at least be wanting the tax rules to change up to a $2,000 tax exemption, simply to keep up with ordinary time earnings, but that was not the case. There's also been calls for changes in respect to the termination of employment early tax trigger, which Sean's talked about, and perhaps Angela will be able to give us a little bit more information on at the end of this webinar. But at present, even though there is talking in respect of those changes, because it is, quite frankly, a very unusual rule when you look on a global basis. Basically, having an early taxation point, it causes all sorts of issues, which Sean's commented on in respect of taxation. But at present, we still have that as an early tax point. So looking at I've called it all ESS startups. So this is a very short summary in respect of the ESS changes to startups. It was a totally new tax regime introduced as from 1st of July 2015 in respect of grants or offers, acquisitions of employee shares as from that date. Now, there's basically the company needs to walk through a number of steps. And the first one is, does the company fit within a definition of a startup? And you'll see that it's very clear what a definition of startup is, well, in the sense of very specific parameters. And there are some issues in respect of, should this really be the case? Is it going to cause issues in respect of, allowing access to the startup concession for companies that quite properly ought to be able to take the benefit? But if we look at it, it's, the company needs to be unlisted. The company needs to be incorporated for less than 10 years before the ESS interest was acquired. The corporate group, all of the companies in the corporate group need to be incorporated less than 10 years before the ESS was acquired. We're looking at aggregated turnover of 50 million, though one of the issues there with the aggregated turnover was, of course, many startup companies do get external funding from venture capitalists or angel investors who take an interest in return for the capital contribution or the investment in. Therefore, the provisions do hive out in certain circumstances investment by angel investors and venture capitalists, but generally you've got to have an ESS, the company has to have an aggregated turnover 50 million or less, and the company must be an Australian tax resident company. So they're the broad parameters in reference to definition of a startup. You then basically have the general and specific conditions that you would otherwise have for concessionary tax treatment in respect of employee share schemes. So, your usual employment conditions, ordinary shares, share trading companies, etc. are excluded. The significant ownership and voting rights condition, before 1st of July 2015, that was 5%. It was increased to 10%. And again, that does cause some issues in respect of very early startup companies where the founders are taking a interest in the company of greater than 10%. So it's basically hiving those out. That's something that is being talked about, but at the moment it is an increase from 5 to simply 10%. And then you have specific conditions for the startup schemes, minimum holding period condition, which is basically the 3-year, for want of a better term. They want the employee who is taking the ES interest to participate in the company for a period of time, a minimum period of time. And the share scheme, so we're looking at shares rather than rights or options, etc., that must meet broad availability. So the 75% 75% of permanent employees must be eligible to participate for a share scheme. So if you grant rights under the employee share scheme startup provisions, you must have an exercise price or strike price greater or equal to the market value of the ordinary share in the company at the time that the rights acquired. And for shares, the maximum discount that you can have is 15% of the market value of the share when acquired. and if you do meet all of these conditions that we've just run through, then the discount on the shares, so that up to 15% will not be subject to income tax, so it will be subject to capital gains tax, when the employee ultimately disposes of the shares. And the rights will be treated as on capital account, so subject to capital gains tax, and deferred until sale of the resulting share. And in both cases, what that's doing from a tax perspective is moving any benefit provided to employees into CGT, and for CGT purposes, if you've held the asset for more than 1 year, then you're eligible for a 50% concession, giving you an effective tax rate of half of the marginal top rate, or whatever tax rate you're in as an employee or an individual. So were there any, changes that we could actually, use for broad-based plans, all employee share plans, other than, the startup concessions? Sean's already talked about exercise, adding an exercise condition to forfeitable matches of shares for broad-based employees. So, as Sean noted, you would have to manage basically the you would have exercise on an ongoing basis. If you're looking at a broad-based scheme, you're going to look at many, many more employees than you would have if you're looking at the executive or key employee group. So you would, the company would need to be tracking, and the employee share scheme reporting would be much more difficult. So is it suitable for broad-based plans? It might be if you the company offers exercise windows. So basically you simply say to the employee group, you can only exercise within, a month, and actually map out the particular month in which all employees can exercise. That would enable the company to manage, the exercise windows. Do we anticipate that we'll see exercisable broad-based schemes? That's a good question. I'm not sure, given the complications of reporting and exercise tracking, etc. So what you're seeing with employee share scheme rules is that, and Sean noted it before, we've got basically a regime at the moment where a company may have an employee share scheme that they've been offering from before the 1st of July 2009. So if we had 7 or 10 year share plans, basically a life of, if it was acquired before 1st of July 2009, you have the old rules under 13 Cap A. If you acquired the shares on or after the 1st of July 2009 up to 30th of June 2015, you've got the 83 Cap A rules up to 1st of July 2015. And then post that, you've got the new ESS tax rules. So it's quite complicated, and what I just wanted to flag is that because of these complications and the new tax rules introduced, the tax office is basically updating its ESS reporting. So the ESS annual statement and the tax office reporting is going to be updated for the year 2015-16, so the current year we're in. The other process that they're introducing is no longer allowing paper submissions by companies. I think basically this is to, manage the amount of documentation coming into the tax office and the way that it's delivered to the tax office, so it's going electronically. So the form you will see will be more complicated as a matter of course because of the changes in rules. And the electronic filing. So if you are amending your share plan rules to change, to better reflect the modifications in the tax rules as from the 1st of July 2015, you will need to note that it will, in all likelihood, add to some complexity in respect of the employee share scheme provisions. Non-executive director share plans. What are we going to see there? I mean, we're already seeing some changes, but of course, you know, they wouldn't have been implemented too quickly as from the 1st of July 2015. However, it has been drawn to my attention that perhaps companies would like to check in on the Ramsay Health Notice of Annual General Meeting from 2015, where basically there has been, well, the company introduced a change in their share plan in order to deliver shares to non-executive directors, where, you know, quite frankly, the non-executive director, the ESS interest, was able to take the benefit of the new tax rules, not be taxed up front on the delivery of the shares, deferred tax time because of the ability to basically say that if the interest wasn't transferable as at the date of acquisition, subject to exercise, for instance, the non-executive director could defer their taxation point. So we may see more of those sorts of changes in respect of non-executive directors actually being able, or companies delivering shares to non-executive directors. The only point where we're looking at good governance issues is whether or not the non-executive director should have shares, and the question is, should they have shares with performance measures? So that may be a question there. And sorry, we've just got a couple of questions. We're just going to open up so we can read them. Oh, good heavens. All right, a person talked about the broad-based plan, 75% of employee population is invited or is eligible. Basically, offers need to be made to 75% of permanent employees, the definition with 3 years of service with the company, etc. They need to be offered, so of course in order to receive an offer they need to be eligible and an offer made. They don't have to basically take it up, but it does have to be both eligible and invited, quite frankly. You can't cut down your eligibility in respect of your employee population and then say 75%. It's a matter of fact, you need to be looking at the look at the employee population, 75% of employees. When you make that offer, could 75% of the employees actually be eligible, actually be able to take up? No, sorry. When you make the offer, it has to be made to 75% of the employees, permanent employees at that time. So I think what the question's getting at is, could you restrict your eligibility? No, you need to look at the employee population and then determine that population and make an invitation to that population in order to get that broad-based eligibility rule. I see from slide 13, qualifying. All right, sorry, we're reading the questions. We can't read and answer at the same time.
While Sandra's reading that question, just coming back to the 75% test issue, I think the only caveat to that is it is limited to employees who have been employed for 3 years.
Yes.
Yeah, so that does limit the pool somewhat.
Yes, absolutely, Sean. So if you've got, for instance, a new company and it's got no employees with 3 years of service with the company, then, you know, as a matter of fact, you cannot offer to 75% of employees with 3 years, if you understand, because there are no employees with 3 years. So you can restrict the offer. in that case. But if you do have employees, 75%, sorry, if you do have employees with 3 years of service with the company, I mean, the rule's slightly more complicated, but we'll just, summarise it in that way. Then you need to make an offer to at least 75% of those employees. The other question is, if qualifying share are taxable on the earlier of, taxable on cessation of employment, and the company is going to issue shares to an employee who's already ceased employment, does this mean they won't be entitled to the startup tax concession?
I think the answer is yes, it does mean they won't, because I think one of the fundamental requirements for that startup tax concession is that you need to be an employee of an Australian resident employer on the date of grant.
The employee is defined widely. So if you're saying to me they're not a director, they're not a consultant, they're not an employee.
So I thought that the issue was that they've already ceased employment.
Yes, I know, but if they're providing other services, maybe.
Sure. So if they are a contractor, then the definition of employee does extend to, for example, contractors who are individuals. But if they've just ceased employment and they've got nothing to do with the startup anymore, then on the date of grant of this share or right, then I don't think they will satisfy the requirement of being employed by the Australian resident employer.
So I think that's the short answer. If they've got no association whatsoever with the company, providing no services, employee or otherwise.
Yeah, but then also query why are you doing it?
I don't know, past services perhaps. Maybe there's an issue in respect of past services, but not currently.
Yeah.
So the only other thing I just wanted to say from a broad-based, yes, past services is the comment, in respect of past services. Without further information, etc., I'd have to say you would have an early termination point. You're taxable immediately, or don't fall within the ESS startup concessions. But we will take that under advisement.
Unless they had a right to be granted it before they ceased employment, then maybe you could bring it back to
right, yeah,
to the date when they had a right, because presumably you're not just going to decide to grant it to them once they've already left for no reason. So maybe if there was some earlier right that they had to it before they ceased employment, maybe that would help you out. But it's really quite an odd fact pattern, so I think
take it under advisement.
We're not going to solve that on the call, I'm afraid.
No. And the only other thing I was going to say from board-based plans, I mean, the fact that the Australian tax rules have changed as from 1st of July 2015 means, I think, that Australia has gone back to replicating, the general rules from a tax perspective on a global basis, which will mean that Australia will probably start looking more like, what sort of plans do companies offer on a global basis. So share purchase plans, very, common for broad-based individuals, and then on a global basis, share option plans, which is market value options, and share awards being rights to shares or restricted shares, etc., would be Australia. So we better hand over to Angela quick for some closing comments and what she's seen from her consultations.
Yeah. I'll come up as soon as I've finished. Yeah.
Oh, except I think we just had somebody who's not on mute. Angela?
Thanks very much, Sandra. I might do some quick closings because we've got about 10 minutes, and I know that there is one question outstanding for you, which we'll take at the end. So I guess when the changes came through, the reality was I think most companies went, or most listed companies went, it wasn't significant changes initially, because I think the the thought was that it would be a reversal fully of 2009, where in reality that probably didn't happen, except for the option plans, as has been our option and rights plans, which has been pointed out by the other presenters. So I think there was a little bit of a non-plus reaction initially, and I think, in fairness, when we went through some of the consultation and lobbying with the politicians, it was really interesting that the thing that they were most interested in was the exercise of options and looking at options. And of course, in the end, that's what really changed. That said, as both of the other presenters have very eloquently pointed out, there are a couple of things that are really key for people to point out, which is, that rights and options are now far more easy, options particularly are far more easy to implement for companies. So for companies where option plans were the right choice of vehicle, it's now much more possible for them to do that. Also, as has been pointed out with rights, I guess there's two things there that I think have already been emphasised, that it becomes there's no requirement for a risk of forfeiture, which was an interesting addition to it and makes rights more possible perhaps for the salary sacrifice side of things. But also with rights particularly, prior to the legislative change, most people were doing automatic exercise. And so the dialogue with companies has really been about, do they allow people the right to choose the exercise point? And a lot of dialogue that I've heard is about the effort that's involved with that. So I think people were generally quite happy when it was an automatic vesting, because it made automatic exercise at vesting, because it made it a lot easier for companies to implement. And Sean, of course, you pointed out some of the worst case scenarios where people in fact don't do anything, and the company is left with dealing with that situation at an endpoint with very senior employees and with very significant amounts. So I think people are still working out what to do, but I think your idea of changing the rules to allow for an automatic in the case of rights is probably a neat way of dealing with that. The other thing that sneaked in that obviously people have emphasised is the 15 years, and that was never really on the radar in the process. So I think, Sean, you asked the question, where did that come from? I don't know that I'm necessarily really, I don't know how the thinking behind that came up, but perhaps it was because they knew that they weren't necessarily helping more broad-based plans out of options that they chose to do that. The way forward and what we've been talking to politicians about has been predominantly three things. So in the listed space, certainly, which is around removal of cessation of employment, because for a very long time that has been a thorn in everyone's side. We're completely out of kilter with the rest of the world, and it doesn't make very much logical sense now with the reporting regime that's in. That perhaps the trade-off for that, and I think is the withholding side of things. The ATO has been reluctant to talk about withholding, has been a little bit concerned. I suspect because the previous reporting regime was implemented in a very short period of time, and people are probably still licking their wounds over that, not least of all the people who had to implement it. So I think withholding may be something that we can use as a means to prevent arguments against cessation being removed. The other thing, of course, as Sandra mentioned, was the $1,000 being increased, which really has been in place for just so long that it's fairly ridiculous. I guess a couple of things that are quite interesting that are fairly recent developments in the conversations I've been having. First of all, the innovation agenda, when that was launched, it had a very specific area around employee share schemes, which was very encouraging that they'd made the connection between employee share schemes and innovation and the importance of them in the overall agenda of things. So that was a significant initiative from the government, and to have that element in there. I'm aware that the initial thinking about what the reporting changes will be has started, and I'm hoping to have a conversation with the Department of Innovation in the next couple of weeks about what that could look like, particularly trying to tie it in with some of the crowdfunding changes. So the exemptions that sit in the Corps Act, perhaps changing those to increase the number of employees or increase the size of the offer there, just to make it a little bit simpler for people, and particularly employee share schemes in that. I think the other really interesting thing is that there are a number of conversations happening about whether employee share schemes should also fall within the superannuation agenda. And with that, I think the interesting conversation is about how to increase super through employee share schemes. And it's something that's been underlying in conversations for a very long time, but is still relatively new on the politicians' agenda. So most of our focus obviously is around cessation of employment, $1,000, but we're also exploring how potentially we could get further changes through on the back of a superannuation agenda, given that there is a review of that policy and that legislation at the moment. So I guess that's a fairly good wrap up. One thing I would say is there's strong bipartisan support, which is the first time in a very long history that I've been involved that there has been that bipartisan support. So I think it gives us a very good playing field on which to offer changes, providing they fit within the innovation, productivity or savings agenda. So I guess that's all I wanted to round off with, and of course to thank everyone on the call. I believe there's one more question outstanding, which may be for you, Sandra, and if anyone has any more questions, if they want to type them now into the chat box, and we'll answer those to finish off the session.
Okay, let's have a look.
Right, so
there's a Sean one.
Yeah.
It specifically says Sean, so I'll hand it over to him.
So someone had a comment about a new employee being given a right on day one with a forfeiture condition. Is it possible to take this a step further and allow employees to sacrifice future salary increases into rights with a forfeiture condition for all employees? Now, I guess the first point there is we would have thought that you were meaning without a forfeiture condition, because it wouldn't make sense to us to sacrifice something that you are going to get in the form of salary for something that is forfeitable in the form of a right. But in theory, yes, it would be open to a company to grant you, for example, fixed. This comes back to the point of a company granting you fixed remuneration effectively in the form of rights to shares with a deferred taxing point, and that can be done now.
Excellent. There's just one comment here, which is about the pros and cons of adding an exercise period to rights plan. It's a comment, but the individual said, as well as administrative complexity of adding an exercise period to rights plan and the costs, it makes it more complicated also for the employee and so harder to explain. So the complexity could lessen the perceived value for participants. And certainly outside of Australia, it's not really common. So I guess that probably suggests that an exercise period for rights plan is probably not the best thing, or not the easiest from very many different perspectives. Excellent. Well, if there's no further comments or questions, I want to thank everyone for joining the webinar, and particularly as well to our presenters for some very insightful and fantastic presentations. So thank you, everyone, and please feel free to do some feedback, but this recording will be available online as well for everyone. Do you, Sandra or Sean, do you have any closing comments?
No, thank you very much for inviting us to speak to the Employee Share Ownership Group.
Brilliant. Thank you very much, everyone.